Today, folks, we're talking stocks, baby, as our portfolios continue to propel to all-time highs. I really want to, though, boil it down a little bit more in depth with the conversations that so many of you have been having this week around Warren Buffett, UnitedHealth, of course, we'll talk about. I want to kind of pivot into some of the Canadian valuations, what's going on here in the Canadian markets. Again, really diving into some of your comments and questions over the week because there's always so many of you that humbly take the time to report your ideas down below, and I do read them more often than not. I don't always reply, but I do try and pull some of them up on the stream as we're going to do this evening. So if you're on the path to financial independence, if you damn well one day want to retire early, join me by hitting that subscribe button, folks, because I know talking about stocks every single week can make you a bit squirrely, but we try and keep it on track. Don't get too crazy and chase too much here. But I think this should be a fun conversation because, again, people are continually talking about valuations in the market. We're looking at already a green futures. I don't trust the futures all that much, but you can't help but recognize that we're on a train that has been quite unstoppable as of late. And does it put me on edge? Of course, puts everybody on edge a little bit, but we'll talk more about that in the latter half of the stream and exactly kind of, I think, some words of wisdom that stuck with me this week when it came to just managing a portfolio. But excluding my speculative plays, my small caps, my crypto, and all the other stuff that the degens like to play with out there, the vast majority of my portfolio has been doing exceptionally well. As we've talked about the returns of VDY, VOO paying out like massive returns over the last 5 years. They're trucking along. A little bit of XQT we'll talk about here as well. And Google and Meta when I wrote back around. I haven't updated my dividends. I did get that dividend check from VDY. I do not have it set up on a drip right now. And to be honest, I haven't bought a whole lot of stocks. The last few weeks been more or less focused on paying the mortgage down. Our last, I think we're officially 2 years into our mortgage come September, and we want to do our next 15% payment. So I've been really trying to build the mortgage account up to do that payment, but also make sure there's some surplus cash there so we don't drain the account to zero. But that'll be nice in this bull market. And then I'll pivot back to more stocks and kind of rebuilding up my last bit of TFSA contribution room. But what's been driving the portfolio this week in the markets in general, obviously the big tech with the exception of NVIDIA and Microsoft, Apple, Google, a lot of the laggers, Amazon, Meta is continuing to truck back up here, even Tesla, Berkshire. There's a lot of green across the board this week, and these are massive movements from the mega caps on the US side. On the Canadian side, it's been a bit more spattered, actually. The tech companies have been drawing back. I mean, we've seen Shopify down 5%, Constellation Software got hit. That one dropped quite a nice little chunk, almost 7%. TD's up 2%. The banks have been the huge driving factor here for this week specifically. But yeah, pretty spattered and comparable. And talking about Royal Bank, this one perplexes me. And I know they got some bullish news, some sales. There's a lot going on with the company underneath, but with earnings just around the corner, I'm curious to what has been driving up the expectations, or if it's just people flooding into things like VDY and indexes that have driven up the vast majority of the value. Because again, like I've talked about this, Royal Bank's trading at its highest value in its entire history. It has been one of the most resilient Canadian stocks out there, but as mentioned, like its PE typically trades between a 9 at the lowest, a 6 in the earlier 20-teens period, but anywhere from usually like an 8 to a 10 is more average, but now we're at 15. So I don't know what earnings are going to do for this company because, this isn't a company, in my opinion, that, has insane like earnings growth. Like, I mean, their earnings are pretty equivalent to where they've been. It's like we're not seeing like crazy double-digit growth. We did see a nice little bump there back at the first quarter of 2025, but historically this thing is growing single digits. But it is doing some, actually it's not even doing share purchases right now. It's actually been doing some share increases. Maybe that had to do with, did that have to do with the acquisition of HSBC, or was that prior to that? Who knows? Maybe that had something to do with that as well. But again, there's the metrics here just don't scream crazy growth company, right? So this is why, again, there's concerns of how long does this perpetual growth rate kind of go on for when earnings are good, but they're not justifyingly, rocket all-time high, Palantir 700 PE like multiples. I'm just saying. But someone made a funny comment too. Totally thought RY would stock split this year. I guess since brokerages are allowing fractional shares now, that could account for stocks not to split. I'd like your thoughts on the topic. And I think this is a fun idea, but a little bit of a stretch. I don't think companies purely care about, stock CDRs or, basically anything that kind of gives you a fractional share of a company. I honestly think it's mostly just the fact that companies will inevitably split if you're just patient enough. It doesn't happen like usually as quickly as you want it, but look at Meta. Meta's going to do a stock split soon. A lot of these mega caps, when they start trading up way too high, they know they usually get an immediate stock boost if they just cut the stock price. And it's nothing more than, just a filing. I mean, it's not that big of a deal to do a stock split. But speaking to the Warren Buffett side of things, I think it's relevant to kind of dive into some of the dividend stocks that are a little bit more relevant today when it's a value setup. And a lot of people have been screaming the value behind UnitedHealth. I am going to explain to you why it's kind of obvious that Warren Buffett bought it, why I would still not buy it for myself personally. And we'll just kind of do a quick comparable to the broader portfolio that Berkshire has. And it's kind of getting a little bit, I don't know, it's almost... I get like honoring Warren Buffett, but he's on his way out the door right now. Like he's announced his retirement. I can't imagine him being overly involved in a lot of these decisions as much as, Greg and Abel are. And I don't think they get enough credit at this point because they are the ones that are virtually taking over this entire portfolio, especially now that, rest in peace, your soul, Charlie Munger is gone. But if we take a look at Berkshire's portfolio, it's kind of crazy to think Apple's been cut so far down now. It's kind of the same position sizing as like their American Express and, Bank of America is a bit smaller, but these are all pretty sizable positions now that are a little more equal weighted. Again, this is the equity portfolio, does not take into consideration the cash or all the other stuff with the private investments. But a lot of people have been focused on the new investments so much, and it's been driving so much hype. But I think people keep forgetting that, they've been buying Constellation Brands and, in fact, increasing their position. It's a bigger position right now than UnitedHealth is. And it's likely if they stick with these positions, they're going to keep increasing them because it's seemingly what they do, with the exception. I think their biggest regret was probably selling Taiwan Semiconductors. And that kind of hurt me a little bit, too, because I flipped out on it when I was a little bit worried. But, they missed out on that massive boat run. And it was so weird to see them buy such a large position and then sell it like within a quarter. Seemed a bit peculiar. But when you look at things like their more recent positioning, like Domino's Pizza, for example, Domino's, I don't get it. I get it and I don't get it. It's like, pizza's not going anywhere. Sure. Does it have a real moat? I don't know. I don't care for Domino's. Like I have pizza places I like. They're a dime a dozen. They're all over the place. There's Papa John, like you name it. I mean, go look at Barstool Bets and their pizza reviews, one bite, the rules. Like, I mean, I'm not sure what the deal was with the Domino's purchase. The stock doesn't appeal me all that much. I don't get it. Same with Constellation Brands. This company's done a horrible job with management, similar to the tobacco giants, like buying into the MJ boom, losing huge amounts on Canopy growth. Like they're dealing with like the Terrafor. They have one of the most popular South American beers, like, Modelo. It's also one of my favorite beers. Not that I really drink that. I can't remember the last time I had a Modelo, but I do like them. And I like some of the products this company offers. But again, like they're having a lot of problems right now. There's some uncertainty. They're dealing with negative earnings right now. I don't know. I am perplexed by this one as well. I've just never found it so bad appealing, especially after listening to the CEO. And I'm not sure if the same guy is still the CEO, but he was always like him and his son that were heavily involved in this company. But that leads up to the question then, with those stocks that haven't been doing that well since they purchased, is the hype truly worth backing with UnitedHealth Group? Because UnitedHealth Group, every one of the grandmothers been talking to me about this one, because obviously ever since the assassination of the CEO, and I mean, there's been competition at play. There's been some headwinds beyond that as well that the company has been facing. But the fundamental reality of the company is, if you don't know or knew that any of that was happening, the stock actually looks quite reasonably valued. I'm not someone that lives in the United States. I'm not someone that understands health insurance. I talked about not buying things you don't understand just because the fundamentals make sense. If I'm buying an individual stock, it has to be a ride or die, and I have to know it in and out. But from most investors in the dividend world, they're drooling over this company right now because it's paying the highest yield it's ever paid. It's wiped out 5 years worth of value, but this is off a lot of drama and not so much fundamental related, right? I mean, you look at the growth rates here, and the company has pretty consistent, high single to low double-digit growth rates. And when you're generating like $420 billion in revenue, but very similar to Amazon, I don't think this equates very well to the revenue side, because this company has to make that money and pay a lot of it out. Like, obviously, I mean, they have the highest, they're the largest insurer in the United States, but they also reject the highest amount of claims. It was something like 30%. It was wild. I mean, regardless though, like that $422 billion or whatever in trailing 12-month revenue, again, it's like Amazon. Amazon brings money in, but they immediately have to pay it out to the guy that owns the friggin' products that's selling it. So similar to this, yeah, it comes in premiums, but a lot of it goes out the back end. But if we take a look at the earnings per share themselves, they're still very strong. Like their earnings per shares, yeah, they're down a bit, but the reality of like the 5-year history, they're still trading at really good earnings. It's a company that has been buying back shares at a reasonable pace. They check a lot of the boxes that I look for if I'm looking for fundamental plays, right? So I can see, I get it. I know why people like this. If we take a look at the other ratios, or let's just take a look at the dividend ratios here, because I know people love seeing this. And look at this. I mean, the company historically paid out a 1.5% yield, and now it's paying out like a 2.7, 2.8. If we take a look at the price ratios real quick, I mean, this is the lowest price to earnings multiple since going all the way back to 2014. So well over a decade back in time. So, I mean, yeah, if you like this company, if you understand healthcare, if you think you get the insurance side of it, if you don't think it's going anywhere, and Warren Buffett, a guy that is really big with Geico and a lot of the insurers out there being some of their largest positions, this one actually makes sense for Berkshire, in my opinion. But it'll be neat to see how it recovers and, you know, if it can kind of come out of this doom cycle. But you know, in the US, people are pretty willing to turn around on negative sentiment. I've talked about sentiment plays, and they can be a bit risky. If you look at China as an example, if you believe in value and you're chasing stocks like this, you could put the same argument behind Alibaba, JD, a lot of those stocks that are even starting to do quite well. But, you know, a lot of people don't want to touch them because of China. And, you know, those rhetorics can really follow these stocks for quite some time. But if you're a long-term cost average investor, you know, that should be something that you are looking forward to, right? I mean, it should be something that excites you overall. But I also ask myself, like, why isn't Buffett buying things like Nestle or Berkshire, diving into some of these stocks? Like, there's so many companies out there right now that are trading at 52-week lows. You know, they're also dealing with troubling times, you know, a little bit of volatility in their earnings, but I still feel like a lot of what these companies are going through are going to be short-lived. I think in 1 to 3 years, these will be turnaround stories. I mean, Nestle is like the largest food company in the world. You know, I drink instant coffee. That's all Nestle. Like, Nestle has so much product. It's just ridiculous, you know, and they've cut their market cap by like what? By 40, almost by half. So this was almost at once upon a time, like a $350, $400 billion company. And, you know, now it's just going through all these headwinds, and it's just crazy to see how much it's down for how consistent, you know, some of its past history has been. And when you look at the fundamentals, again, like, revenue has been very strong, you know, a little bit of volatility in 2023 coming to 2024, but overall, the company is working with so much revenue, and, you know, there's just a lot going on here to in my opinion, to be excited about. There's a lot of concern again, revenue, but let's just take a look at the actual income statement. I mean, they're doing like $90 billion in revenue. I was looking at their balance sheet there, but, you know, when you look at their gross profit, like even their gross profit margins are still quite incredible. The company has just so much bleed room. And I mean, if we take a look at the dividend payout as well, what's the dividend payout ratio here? It's probably like, surprisingly high right now, 75%, but that's on the back of, again, you know, the volatility that they're already experiencing their earnings. So they made room for a lot of this. Like, I think it's a safe company. I'm always intrigued by it, but it's just not enough to make me buy it, which is the question, right? Like, why wouldn't you buy it then? Why would you think Buffett would buy this stuff? And I kind of say the same thing about TELUS, right? Like, I look at TELUS and I'm like, you know, if I'm an income-oriented investor, these are stocks that I would be looking at. But the problem for me is I'm still a total return investor, and I'm on this like final, you know, this final frontier of where I want to reach my financial goals. And I'm just eyeballing it down in the next year or two. And it's just like, I still am looking for where fundamentally things align in a way where I understand it. I'm comfortable with the volatility. And I think that's the question, right? Like, are you comfortable if these stocks drop materially? And I get different feelings about different companies when I ask myself that question. And TELUS is a company, you know, this is a hard one for people. And the landscape has been changing, but if I was a dividend investor, I'd be pretty excited here from a fundamental standpoint. You probably use a cell phone service. Their revenues are incredibly stable. I mean, they're not growing by any metric here. And this thing doesn't tick a lot of my boxes, which is what holds me back from buying it right now. Because again, you look at UnitedHealth and you got a company that's buying shares back. They're having revenue growth still. You know, the earnings are still strong. This company is a company that's diluting shares. You know, their earnings per share growth has been only on a recovery play now, kind of coming through this high interest rate, this restructuring. And that's why I think it's a buy now, because you can tell that the company's turning around. So if you want to dip by something like this, I think it's a great opportunity for, you know, income-oriented investors out there that want to buy fundamental companies that are finally in these turnaround phases. But again, these don't check all my boxes, right? They don't give me that comfort level that I want. And if you just look at a company like Google and why Google is such a material position, to put it in perspective, like, between Meta and Google, in our combined accounts, between my fiance, I mean, we're talking about 6 figures just in 2 stocks. And I sit here every day and like, I have no concern about that at all. Obviously, I'm going to scale them down here sooner or later because I'm just using them as like a 1 to 3 year growth play. I want to keep them long term, but the size of the positions that we have are just to capitalize on the near term growth that I think is being misappropriately priced. And this is like my UnitedHealth. Like for Warren Buffett, he can stick to his insurer players, but I'm a tech guy. I use tech. I'm integrated in this like there's no tomorrow. And we all know Google should be the largest company in the United States. If it was purely net income based, there's no company that makes more net income than Google. And it's crazy to see a company that's generating this kind of net income that is still growing it by 20% in the high like 20 percentile range. It's ridiculous at the scale of this. And no one talks about it. No one appreciates it, but people are starting to, right? They buy their shares back. When we talk about like price to earnings ratios, which make a lot of sense for a company like this, they're trading at price to earnings ratios that are actually some of the lowest in the company's recent decade of trading. Like there's a lot of things about Google that just don't make sense to me. So like I'm so comfortable holding this stock through any kind of volatility, even with the scale of the position in our portfolios. So, I mean, that's why it makes more sense for me to own this than say something like TELUS or UnitedHealth. Like if I bought UnitedHealth, guys, I don't know what the business is doing tomorrow. I've never paid for healthcare insurance in my life. I'm a Canadian. It just doesn't make sense to me. But Google, like I said, and I think this is kind of the formula that leads to success in investing. And if it doesn't, and I get bit in the butt here at some point, you guys will be here to see it. But getting into some of your Q&As and this market valuation being a bit compared to average, or sorry, let me make sure I'm reading this correctly. Sometimes a bit slow, not stupid though. In this market, valuations being a bit high compared to averages and a lot of concentration in tech, could XEQT be safer hands off alternative to buying individually VOO or VDY? Would love to hear your thoughts on this. So the best advice I ever heard, at least recently, when it comes to investing in risk, there is actually the real risk of investing in the market isn't actually the volatility of the stocks, because regardless, there's going to be volatility. I mean, the S&P has had historical, periods where it's dropped 40%. It's been less than a handful of times, but it's likely it's going to happen again in your lifetime. So you have to be prepared if you own these broad indices that, economic circumstances can lead to wicked downturns in equities globally, which we saw in the pandemic. So it doesn't really matter if you don't want the concentration risk, because volatility equals reward. Higher volatility, higher reward. Obviously, the more you concentrate, the more risk you're putting on. And if you're buying individual stocks, I think that's like the pinnacle of gambling. Regardless, like even buying Google is the pinnacle of gambling. All individual stocks are. But when you buy the basket, the ones that, you're removing that individual stock risk, because there's a lot of circumstances and no one talks about it right now. But if you went back to 2022, look at how many companies went bankrupt. Look at how many companies have not recovered from their lows. I mean, you remember the very good food company? I remember Jeremy. I've been talking to people one-on-ones that actually lost a lot of money, being told to cost average into these new growth sectors. We're hearing very similar stuff to AI and crypto right now again. So I don't think, for me personally, when you're buying something like the S&P 500, that you're really buying all that much risk. The real risk is you selling out when the roller coaster drops by 40%. That is the risk. So the question is what will you need to buy to give you exposure to the markets where you're not going to make the stupid, risky decision to start gambling on what happens tomorrow? If the market goes up, are you going to keep buying? If the market goes down, are you going to sell? Like you need to stay in the market. So a lot of people, I don't like, if VOO is too risky, because I hear a lot of people say, oh, like America can't win forever. And I'm not looking at it as America winning. I'm looking at a basket of companies that are market cap weighted. And as they ebb and flow, they will weight themselves in and out of the index. And it just happens to be the best, country and laws that have allowed those companies to spawn is America. So like, I would rather have that bigger exposure, knowing history has told us that's where the returns have been. And yeah, things are overvalued, obviously, right now, but I don't know what happens, and neither do you. You don't know if the market runs for another 2 years and then corrects by 20% after running another 30%. Nobody knows, right? It could correct tomorrow and you'd feel like an idiot after buying. But again, are you in the market for a year, 5 years, 10 years, for the rest of your life? I'm a guy that'll never sell these positions. Will I use them in retirement? Sure, but they're going to be like lifelong never go anywhere. Like they're going to be there regardless. So like, I can't sit here and say, yeah, XEQT is the better option. I mean, I think for most people, a global market ETF, this is the way we're going to be moving over time as our portfolio kind of gets, once I reach my goals and I start getting past that, most of my money allocation will be to this ETF. I like XEQT. I like the global diversification. It is kind of a one size fits all shoe for investing for most people. So go for it, right? Like I think if it stops you from playing the market, then just do it. But don't be, thinking that it's removing risk, because you have to understand the S&P has been yielding about a 14% return over the last 15 years, whereas this has been yielding about 12%. So again, you're still getting kind of the same market risk, but if the market corrects, you're not going to see maybe as big of a correction, but same to the upside, right? Because you're not getting exposure to the best possible market. You're not going to see the same kind of upside potential. So you're limiting yourself to that. But honestly, a 12% rate of return is still ridiculous, considering that's what the global markets have been relatively offering, which is great to see, right? So I sold both my ENB and TD this week at peak. Now I'm pushing to push my ETFs into VDY and VFE. That's my dynamic duo going forward. So again, when you're buying these ETFs, just make sure you got the long-term perspective, because when it comes to down periods, these things can lackluster for years, just like they did in the dot-com bubble. So, I mean, I don't mind if those are your ride or dies, but just like to the last conversation, just make sure they are truly ride or dies for you. And they are for me. And we'll talk a little bit more about comparables with VDY in a moment, because I know some of you have been questioning it comparable to like XDIV. But I've been watching and loving the advice here. One question is, you said your fave ETFs are VDY and VOO. I'm a Canadian and I have weekly buys on VDY and VFE. Should I switch to VO or just continue in VFE? Somebody pointed out that Beavis Wealth, another great Canadian channel, has been posting, questions, answering these questions. And honestly, I think the variables are so minor, it doesn't really matter. Again, I'm kind of a hyper fixated crazy person that just really wants diversity of currency, and I want control over currency. So most of my money is in the US dollar. When you look at my portfolio, if we just backtrack a little bit here, all my US stocks, which is the vast majority of them, VOO, Google, Meta, those are all in US accounts. They're all in US dollars. When I buy and sell them, I'm paying US commissions. I'm converting it just purely to US cash. I'm not trading currencies with it, and I'm perfectly fine with that. And it blows my mind as a Canadian. I can have multiple currency accounts. In fact, when I look at companies like Nestle, in the back of my mind, I'm not at my goals yet, but in the back of my mind, for diversity purposes, I've been debating on opening up kind of a European account for, I think it's euros or whatever that Nestle trades in, and start buying some, maybe even European indexes that might weight Nestle, and look for some further diversification of my currencies. I've been to Europe. I like traveling. It blows my mind that I can live here in Canada and without paying a huge amount of tax, make global income from global currencies and global economies without actually going to those countries and working in those countries. So for me personally, I feel like it's maybe more of a wealth preservation thing. And I don't know. I like it a lot. So yeah, anything you see in Canadian dollars. So I have very little Canadian dollars. My emergency funds in Canadian dollars, but VDY, XEQT, those are the vast majority of those holdings. But again, you don't need to be as crazy as I am. I mean, by all means, just buy VFE and just, no big deal. Do you use a business accountant for your corporation taxes or every year and general accounting and payroll, or do you do all that yourself? It sounds complicated. In a lot of areas, you could break the rules by accident. So here's what I like to say about accounting, especially when you're running your own business. And I don't really care if there's mistakes made, because I've been audited twice already. And I'm not trying to hide anything from the government. If you're honest with your taxes, regardless whether you make an honest mistake or not, you're not going to get really penalized for it. You just have to owe more taxes. But here's the thing, right? When it comes to corporate specifically, you have to have a CPA sign off on your taxes. You cannot do your own corporate taxes unless you're certified. You just can't. You can do your own personal taxes, but not your corporate taxes. That has to be CPA certified when you're filing it. What I do, however, is I do my own accounting. Yes. My accountant doesn't actually look at my books. I send them a spreadsheet, and I am responsible and liable for what comes of that, because my accountant never asks me for my books, like my Royal Bank, like my actual corporate, like in my savings accounts, my checkings, and my credit card accounts. I literally I think I maybe send them to her, but I mainly just give her a spreadsheet. Every year, I don't want to pay them to run through my numbers. So like, I'm a very hands-on guy. Obviously, if you're watching this channel, there's something tells me that you care a lot about your income and expenses. I've tracked this my whole life because I want to save that money and get to financial independence. So when it comes to my corporation, it's the same thing. I have categories set up, and every single month I go through the monthly expenses, the monthly income, and I divvy it out. I talk about this way more in depthly at kylelivingston.com. Links in the description. If you book my courses, and you can go in there and get in my chat group and stuff, you'll see kind of how I run my business and what my business is like on the back end. But the reality is like, I don't want to pay the accountant thousands of dollars because a CPA already cost me $1,200 just to file. So I mainly do all the hard back end work, so she can just do the main paperwork, ask me some questions, make sure things align up correctly, and then she files for me. That's how I keep it generally cheap. But I mean, yeah, if it sucks, there's nothing easy about setting up corporations. It's all a lot of paperwork and bullshit. But if you want to get rich, like beyond like statistical TFSAs and RRSPs, and like actually take advantage of the tax system, like you need to learn that stuff to some varying degree. And I'm very fortunate that I've had the diligence to do that on my own. Because I never hired a lawyer. I never hired an accountant. I literally just one step at a time figured out how to open up a corporation, talked with a bank, set up corporate investment accounts. And I realized you can do it pretty cheap if you have the patience and time to do it. And people will help you along the way. The bank doesn't charge you to help you set up those accounts. They helped me with the paperwork. It was super awesome. And what was really funny, ironically, is, and I've said this a lot of times too, as a Canadian, and one of the things that blows my mind the most is if you sell digital products, say to the United States, you do not have to pay withholding tax. You do not pay the US government anything, and you don't have to pay any HST here in Ontario if you are unfortunately having to deal with sales tax. So you can make US dollars with no tariffs, no nothing, no shipping costs, and it all comes in. It's cheaper taxes. You only pay like 10, 12% up to the first $500,000. It blows my mind. And then I can leave it in US dollars and invest it in US dollars. It's like the weirdest tax loophole thing I've ever seen in my life. And the government called me one day about it. And they're like, hey, you're not filing your HST correctly because you're showing all this income, but you're not paying the sales tax on it. And I said, from my understanding, it's on US income. And I've been told you don't pay HST on that. And the lady's like, nope, you're right. We'll put a note down on your file that you make US dollars. And I was like, bada bing, bada boom. This CRA signed off on it. So I have no anxiety about it anymore. XDIV has similar total returns, but in my opinion, better allocations across holdings and lower management fees. Curious of why you prefer one over the other or hold a good amount of both. XDIV is better than VDY, a little less financial exposure, and I prefer it. So this is a really easy question for me, actually. I'll tell you the two reasons that I prefer VDY over XDIV. Firstly, if you look at the comparable returns, yes, in the same timeframes, which, by the way, they're very different timeframes, which is another reason. One of the main reasons I prefer VDY. If you look over the 5-year, you'll be like, yeah, returns are very comparable. Nothing too crazy here. Yields are great, monthly paying. There's some ebb and flow where one might outperform the other. But the further you zoom out, again, VDY has been OG. It's been around since 2012, whereas XDIV has really only been around since 2017. And the thing is it kind of comes back to my same concern over like SCHD and why I sold SCHD is, if you look at XDIV since inception, and again, it's not a good comparable because it says 10.9%. Over the 5-year, very comparable to obviously, VDY. On the 1 year, I think VDY is doing a bit better, but regardless, they tend to track each other to some extent. And yes, the management fee is about half as much at 0.1 over the 0.2 that VDY offers. But my main concern here is that like you're looking at concentration, but hand-selected concentration. And at the end of the day, like when TD started to underperform, like there's risk. Again, VDY has kind of the same risk, but the difference is VDY is market cap weighted. And when market cap weightings come into play over time, over the very long term, 10, 20, 30 years out, Royal Bank might not be the largest dividend company anymore in the index. So it might get de-weighted and something else will come into play. But when it comes to an ETF like this, you're talking about somebody having to hand select and manage the portfolio. And don't get me wrong, like I like the holdings in this account. Like you got Toronto Dominion, Royal, like it's very similar to VDY in a lot of ways, but still to me, it is a hand selected ETF. And, they're both great. I honestly have nothing against either of these ETFs. You can own either one, whatever you prefer for whatever reason. And yeah, obviously it's not going to give you the same risk if Royal Bank tanks, but as somebody that is looking for purely growth oriented by market cap weightings, I don't care. Like, I would still rather own Royal Bank at the scale that it does in VDY, and I'd rather get the financial risk that offers, diversifying it with US VOO. Those two, just like I said, I'm a guy that just wants, I don't care about concentration. I really don't. So for me, I'd rather ride that bull and get on top of NVIDIA if it becomes the largest company, because I'm not smart enough to buy it individually. Again, same with Royal Bank. Like, some of these stocks you might say are overvalued or undervalued, but the market doesn't give a shit about how you feel or what you think most of the time. Just like the market doesn't care about how I care about Palantir. It doesn't care how I care about NVIDIA. I never bought them individually. It was a mistake. But hey, I still got the upside because I was smart enough to just stay in the index. You're just smart enough to stay in the index, to let it figure itself out. I don't want you figuring it out for me. I've learned that that's not something that is a winning strategy for the most part. So I let the indexes figure that out as time goes on. But nonetheless, what are you guys talking about in the comment sections? We'll flip this around and get into the live combo here. I mean, if someone buys a product from Kyle who lives in the US, wouldn't that be a digital product sold? Yes. So I am a digital marketer. I do very similar stuff to what I do on this channel for individual companies. I help them build out social media channels, help them build capital, a lot of Google ads. I do a lot of Google marketing. I do meta marketing. I'm very integrated into the back end of Google. I know Google up and down, and it's why I'm so comfortable buying it, because I know what makes them that 50 billion. Like, when you see those crazy revenue numbers, I know exactly how that revenue is getting into their pocket. Like, I know Google ads on the back end quite thoroughly, so I'm comfortable with it. But I can go to the US and go look at a business in the United States and say, hey, I see you got a YouTube channel. I see you've got a Facebook account. I see that you need views. You might need to drive some traffic. Let me help you do that. Give me a budget. Let me manage some of your ads. You don't know how to do this properly. What's the point of making the content if you don't know how to distribute it? So I could sell them that digital service, right, where there's no physical goods going over the border, and they just pay me. They wire me US dollars or PayPal or whatever you want to say it is. It's my account. There's no physical products. And this is the same debate that Trump had over Canada, because, I mean, Canada put a 2.5% tax on Google if you were a Canadian or anybody in trying to use Google. Because if Google was going to work in Canada, Canada said it's not fair that they're taking all this money but working in our country. So we're going to charge them the digital service tax. Trump said that's not fair because we don't charge you a digital service tax. Why are you charging us? Because, I mean, Trump could just as easily charge Shopify a digital service tax, because, Shopify is not really, like, if you're in the US and you sign up to Shopify, you're paying them over the border. It's the same thing. It's a digital product. They're not really paying any shipping fees. There's no tariffs on that. It's a really interesting market right now. And I think people are underappreciating the tax. They're not tax loopholes per se. It's just the way it operates today. And I don't think it's going to be that way forever. I just don't. Kyle, have you researched how much energy AI requires? Yeah, I know the energy sector is huge, right? To be made in the next few years, if you pick up the correct energy AI, like, I mean, for sure, right? But this comes back to just Google and Meta for me. I mean, like I said, the pinnacle of all of this to me is, who is the end winner? I mean, NVIDIA is selling chips to the miners. That is eventually going to come to an end. I don't know when it comes to an end, 5-10 years from now. Maybe they innovate and stay on top of something new. But the ungodly amount of money that's being spent to build this out is eventually going to evolve and change. I don't know what that looks like in 5 years. So that's why I just don't want to hold NVIDIA long. But still, the end benefactor of all of this is the companies that are spending this money, the CapEx. So, I mean, how many Gemini competitors are there? There's ChatGPT. There's Perplexity. There's a handful of companies that even have the capital to compete in this landscape. So why, that these companies are going to dominate a whole new industry at some point, and they are already, right? They're wiping out a lot of white collar jobs. So at the end of the day, I want to own those companies, especially the ones that I understand that I'm using today. I don't understand energy enough. I get it, like Oklo or whatever. Like, there's so many nuclear, and I just don't get it. I don't know the regulation. I don't get any of that. I get AI. I use all those tools. Just buy what you understand, because that's where you're going to make the most money over the long term. But yeah, I'm not big into the energy side. I don't really care about energy, and I get it. It's huge. It's going to be a huge industry for sure. I had uranium play. Yeah, uranium is really interesting. I think those are good stocks too, if you have if you have an understanding for it. But similar to lithium, I don't understand commodities, and they seem fairly cyclical. So, and it doesn't take a lot of uranium to power a power plant. I don't know the sector that well. Right now, AI hype is only tech. Yeah, to some extent. And I don't know how much of it is a bubble or not. I think Palantir is a bubble. I think there's some bubbles out there. I mean, they might not be a bubble if they somehow continue to scale revenue and earnings growth. So who knows? Maybe they go up to like, Palantir starts growing at a 50 to 100% clip over time. But what bothers me is Palantir isn't growing faster than NVIDIA is. And NVIDIA, I think, is way more just in its valuations today. But yeah, I don't know. Eventually, this is going to correct. I mean, there's going to be winners and losers to this, and it's going to be volatile. So just strap on, be prepared, and understand, like, new sectors come with hype and volatility. And yeah, I mean, Google's testing out their first drug ever that was made through AI that they're moving into human trials with. I think what's going to be really incredible is when somebody made a good point. The real inflection point is going to come when AI starts training itself and it starts being able to build off its own algorithms and starts being able to actually, because there is no AI right now that is solving problems without us kind of intervening, right? Like we have to build up the models and start training it on certain things and see what the outcomes are. But eventually what's going to happen is AI is going to be like, okay, here's how this works. Here's what we need to do to like continue building on it. And it just starts intelligently implementing and scaling on. It's kind of like the robot building the robot, right? That's the level we need to get to. So like AI can actually start solving its own complexities. Because imagine a human brain, we have to sit here at a desk and solve cancer. It's a very hard problem. But if you can just interject so much information that the AI is able to build off of it and then figure out where the new material is coming from and actually have the intelligence to sit there and draw from that material instead of us that have to sleep like 8 hours out of the day and then go to the office and have lunch. I mean, we're moving into a place that is going to be very, very surreal. It's the exponential curve line, right? Like, I mean, innovation, we're in this weird life phase right now where, I think we've talked about this before. It's kind of comparable to like the late 1800s, like just seeing the first plane invention and cars to all of a sudden planes are dropping bombs out of the sky to nuclear energy to man on the moon. Like a lot happened in a 60-year period, but the next 60 years is going to be, it's going to be disgusting. It's going to be something just out of a sci-fi film, I think. But again, that comes with volatility. There's going to be winners or losers. There's going to be, crazy corrections and all kinds of stuff. Yep, I've been waiting years for it, though. Yeah, a real one that these folks, neural network back propagation is what you are talking about. That is happening already. Yeah, I mean, that's where this, because then eventually what happens, right? Like these, and that could be a benefit to NVIDIA because then these Meta, Google, they say, okay, we're not having to do as much of the programming anymore. We're just scaling the compute power. So then Google just focuses on compute and lets the program continue to build itself and become more efficient. The evolution of that could be wild. The future will be smaller, modular, targeted for specific areas, not all in one for everything like ChatGPT. You find maniacs aside, why would anyone share their next big stock unless they wanted it bought? Yeah, so that's the thing, right? Like, here's the thing for me, really, like personally, that I always kind of have a hard time wrapping my head around is there's a lot of great YouTubers out there right now, like Amit Investing. There's a lot of guys that recently came up quite dramatically because of their picks like Palantir. And I mean, they're getting into a market cycle that has been very beneficial. But the problem is you start building a sphere of pump. And in your mind, it's just like Tesla, right? Like Tesla's a dreamer stock. It's always pushing the goalpost down the road. The timelines don't matter. People don't give a shit. There's just some future that never really comes into fruition that they can constantly, hodl all these pumpers together on and keep them pumping the value up. And that's what scares me the most about companies like Palantir, because there's so much retail involvement. I think 50% of Palantir is retail or something. They're not like the most institutionally held companies, right? So it's like, you got to recognize that you are pumping up the value excessively. And, what happened last time, YouTubers pumped up value stocks in a bull market. I mean, we saw the very good butchers. There's so many companies that just went completely under. I mean, what's the other one? Not the competitor to Nikola. Like, there were so many YouTubers pumping Nikola up. Like, it was just so much pump. And you got to recognize, like, you don't want that happening if you believe in these companies long-term. But again, it's hard to buy companies long-term. It just is. Let's be real. If you go back and look at the 2000s, Walmart, General Electric, no one wants to own that shit today. So that's why when I'm buying and trading stocks, I tell you guys, like, I might be hyped on it today, but 6 months from now might not be the same. Like, you remember I sold out of Google because I was worried they were going to lose market share to search. And then the second I realized that they weren't losing their search market share and the actual search landscape is still growing, I was like, why is no one talking about this? I'm buying it back. And then I went all in on Google, and now it's my biggest position. But I was very fearful that that was a reality. But now I've recognized people don't see that that's not true. A lot of people aren't buying it because they think that's still true. What I think is the reality is they might be losing some market share to ChatGPT and Perplexity and whatever, but the scope of search, the whole landscape is still growing. So even though Google might be losing some users, the end user is still searching way more than they ever were prior, like 5 years ago. And Sundar Pichai confirmed this when I watched him, and no one even mentioned it. He said searches are going up. He says more people are searching as they find search more useful. And then here we are sitting in a period of earnings where search revenue is starting to grow again, but everyone said it was dead, right? So it's like, I trade in and out of this stuff all the time. Like, you have to have rules and fundamentals with individual stocks. You can't just say it's a buy and hold for 10 years, 20 years, set it and forget it. The luck of you buying something like Apple in the 80s or 90s is almost zero. For every one company that unicorns, there's like another 90 over 10 years that basically, like General Electric, go, nowhere, or at least severely underperform the general indices, right? Because why didn't you buy Nvidia 15 years ago? Why didn't you see this coming, right? Like, because no one knows what tomorrow brings. So individual stocks are purely gambling, and you like really have to be on top of your shit. So just, take the YouTube stock pumpers like myself with a grain of salt, because it does come with excessive risk. And a lot of these guys don't even show their portfolios. Agree. What else is going on? There is no alternative to YouTube. So Google is here to stay. My only end bull thesis with Google and Facebook, especially in my job, is the whole world is upgrading from brick and mortar. And if you know any old people right now, like their entire way of communication is starting to be online. Meta, especially with Meta, I mean, WhatsApp is the number one, literal global, messaging app. Like, we're using these digital platforms now as our means of communication, our means of business. The entire world is starting to get access to internet. And with the exception of China, there's only a handful of other apps that are competitors to these companies. They are true monopolies in the way we communicate today. So I don't think people should look at them necessarily as advertising plays, because yes, I mean, if we go through an economic downturn, advertising spending could drop and it could severely hinder the stock. But regardless, if we just remove the idea of revenue and advertising, this literally is the foundation. It's like what Elon Musk said about X. Like, this is the town square. This literally is the world that we live in. I mean, it's destroying lives. Like, you can't say racist shit online anymore. I mean, go back to what the internet used to be, and it was the Wild West. Now it's like we're trying to police each other. It's like, it's literally causing evolution in humanity. Like, we're forcing a whole new way of evolution because of this. It's not you just socializing with your friends anymore. It's you socializing where you're not anonymous anymore. Like, when you post shit on Reddit now, people are trying to come and find you and sue you over shit. Like, it is really weird, and it's just underappreciated. So that's why I love Meta and Google so much. But yes, you get great valuations with them. There's great growth rates, and no one cares about Waymo, genomics, quantum, and that is all under that umbrella. Yet somehow, Tesla has no revenue growth, is worth way more than Google will ever be worth, and everyone's hyped on their future. Yet, Google's the arguable leader, though I think there's room for both these companies. Obviously, there's only like 2 or 3 competitors in self-driving right now. So does it really matter who wins? They're both going to win. There's no one competing with them. There's huge, ungodly market share to be gobbled up by a few companies that have the money to spend on this. I mean, come on. What? So what are you going to pick? The more overvalued one or the cheaper one? I mean, it seems like it's common sense to me, but clearly not to the rest of the world. People thought about BlackBerry as well. There will always be something that will, yeah, I know. BlackBerry used to be a huge company too, right? Tesla just does a short squeeze. There is no valuation metric for it. Yeah, it trades because it's a goalpost. People somehow forget that, like, there's no Roadster yet. We were promised self-driving back in 2019. By the time self-driving is regulated enough, you could turn your car into a robo-taxi. Your car is going to be basically scrapped. Elon overpromises, underdelivers on everything. Cybertruck, it's supposed to do $250,000 a year, and deliveries, nope, barely any of that. Does like a 20th or 30th of those sales. They're losing market share now to BYD, and this started the EV revolution. Like, I see way more negatives behind Tesla today than I ever have, yet people are still more bullish than they've ever been because we moved the next goalpost, guys. Now it's robotics, another business model we don't understand that's going to be great in 5 years, but we'll keep pushing that goalpost. It'll come eventually, but I don't want to wait 10 years. And I don't want the risk of valuations when the market could correct and we could have a black swan somewhere in between. Adobe is another interesting one. My fear with Adobe is the competitors that are coming out, because their revenue is stable. A lot of people use their products. My wife uses their products at work. Adobe's a great company overall, but I'm always a little fearful because of how fast we're seeing the evolution of software. And I'm always a little concerned too with like a Canva. A lot of people use Canva over Adobe now. Some people like it. I don't understand it, but if you love it and you think it's a great company, it is trading at a favorable value today. It is down quite a bit. I know a lot of people are talking about it, but it's just not a thing I understand. So I just kind of avoid it. So let's just take a look real quick at it. Their stock's trading down at what, 5-year lows here, 22 PE. Let's just take a look at their revenue real quick, because I think they're doing pretty good overall, right? I just, like I said, Photoshop, I just don't like how expensive they are. But yeah, look at the stable revenues. You're still getting like mid double digits here. Like 10% is very consistent growth rates. They're doing share buybacks pretty aggressively, like really aggressive share buybacks. That's probably bolstering earnings. Yeah, earnings are flying up as they're buying shares back like there's no tomorrow. The company does check a lot of good boxes if you're looking for some good short-term recovery growth. So yeah, I see why people like Adobe. If you think you like it, I would be buying it here for sure. I don't have anything against it. It's done pretty well. Yeah, I think Optimus is going to come down short of people's expectations. I think it's overhyped. I think the future of what he's envisioning is a reality. I think robots are going to start working their way into our lives. But I think if people think that's coming in the next 3 to 5 years is insane. I think, the idea of having humanoid robots working on a factory floor is dumb. I think it doesn't make any sense, because factories already have robots that are more efficient than humans are. So why are you making a human to do what, a spoon can do better? Like, why would you make a hand if it's a job for a spoon? You're not going to send robots down into a uranium mine. They already have robots mining uranium. The only thing maybe in space travel, if you're anything that's really deadly for humans, sure. But in the meantime, they're going to be so expensive. No one's going to be getting them to do their laundry, like laundry robots. If you want to be real lazy about it, instead of ordering an Optimus, just get 2 dishwashers. Every time you put your dishes away, you just put it into the dirty dishwasher and keep rotating the two. You could do that. If you want to be real lazy about it, let's be real. But I don't know. I think it's overhyped. I really think robots are way too overhyped, for sure. And says he loves working in hotels. Hotels, I could see robots maybe doing some stuff at some point. I think there already are robots doing like toilet cleaning and stuff, aren't there? That's potentially, I told them, if you don't want to be stupid with your 50s, nothing, all my friends work relying on government pensions. JEPQ's not terrible when it comes to the option ETF side of things. I think it's an S&P 500 option ETF, isn't it? I like Devo a lot. I know a lot of people like HYLD is not like the worst. There's some reasonable ones. HMAX, I think, is the bank one that's not terrible if you're looking for some income. But otherwise, Google, Meta, Amazon, Nvidia, these 5 will go to the moon. Yeah, more than likely. They seem to be anyways. What else is going on before we finish up? Kyle, what else have we missed? We'll go back to the top here. MTA to the moon. XQT has same 29.9 overlap in Mag 7 in their US stock portfolio. Been taking Google profits all the way up, still holding your position. I think Google's a good 3 to 5 year hold. I bought an oversized position because I want to cut the position in half. Right now it's like 10% of our portfolios. It's a huge position. I think it's just 10% of mine, maybe a little less than 10 of ours. But I have to keep in mind that it's a huge position in the S&P 500. And when I include the S&P weighting into what we already own, it's like I said, Google and Meta together, we have 6 figures in. They're huge positions considering, but I'm very comfortable. So we'll see what happens. But I will sell them down here probably in the next year at least. I'm just waiting for a nice pop. I want to see a valuation correction. And when the valuations make more sense, then I'll do some adjustments and then probably put it into XQT or finish up my VDY position. What do you think about Intact Financial stock? The financials are all pretty good. I haven't looked at Intact lately, but time will tell. Digging the new DTE cover calls. Yeah, well, before we get into the cover call conversation, I have a complete meltdown over the alti losers out there. Maybe we should finish up here, folks, but I do appreciate the conversations. I hope you're having a wonderful market cycle and you're staying invested as always, because the only people that lose are the clowns that get off this roller coaster when the ride gets crazy. But I'm very excited to see if this market keeps going up, because I am just absolutely blown away. Because again, I don't take crypto and the small caps and private placements that I have into my portfolio, but I just never thought in such a short amount of time, like I'd be knocking on the I'm over $500,000 already if you include my cash and emergency stuff. But I just like, it's crazy, right? Like, I don't think any of us were sitting here being like 2 years ago, this is what's going to happen and this is where we're going to be, right? So you're out of the market, man. Why are you always playing the market, bro? You crazy. I want to sit down. We should sit down, man. We should have a nice private conversation because I'd love to see how you manage your portfolio and just kind of what your thoughts are. And you're an interesting guy because you've been OG, man. You always have some interesting takes. But to each their own. Stay cool, stay awesome, folks. And as always, I look forward to catching you in the next one. Peace.